California just announced and opened up its new program for first-time home buyers called the California Dream for All. Is it a trap or is it a benefit for the first-time home buyers? I will jump into that in a little bit. But first, welcome back to another episode of The Brief with your one and only Kenny Simpson. It's more information, it's more news, it's more drama, and it's a new week. Let's not waste time. Let's get right into it. Here we go. All right, let's jump into basically inventory. We're basically down from last week. Last week we were at 2508. This week we're in 2415, 442 pending. Guys, where is our inventory? Do you have it? I don't know where it is. Nobody's selling. It's hard to sell when those average rates are, 3.78 across all the rates. I don't know. Not much motivation. So we're just not getting the inventory. Mortgage rates this week kind of remaining flat. But look, we're off the kind of highs we were a month ago. So they're down the, 30-year fixed, conventional rates, high fives. So mid fives for FHA, VA. Look, it's a lot better than in the sevens, right? So we're getting some relief there. The other thing I want to talk about is what's going on with the Fed. Before last week, the Fed had met after. After last week's brief, the Fed had met the next day. They raised a 25 basis point as expected. I don't know if you were expecting that or you think this is crazy. What do you think? No, tell me. What do you think? Seriously. I think it was 50-50. A lot of people thought they were not going to hike. A lot of people thought they should hike to keep on track. I thought the Feds were going to hike to 25 basis points. We got it. That puts, that's put prime at 8%. Those HELOCs, those credit cards, those mortgage, business lines, credit, all that stuff. You're seeing those rates go up. Mortgage rates did fall, so that's not tied to the same. Just always want to point that out. So the Feds, do you think they're going to chill? Is this it? They're going to sit here. They're going to let things go on with this banking debacle. Why don't we talk about the banking debacle? Again, I'm going to keep saying this over and over, and I'll always say this. We need the small banks. The small banks fund 70% of the commercial loans and 40% of the residential loans. So when you drive around your town, in your little town in San Diego or a big town San Diego or wherever you are in this country, those buildings, those businesses, and all that little small town stuff, that's what we're saying is, that's funded by the regional small banks. We need them. So don't pull your money out. Don't freak out. The Feds backstopped it. They got you. Continue to bank where you are. Go meet with your banker. Strengthen your relationships. Get in there. Yeah, maybe you got to move accounts around or do things. I get it. But this is the time to go, let me take all my money and just give it to Citi or Chase or Bank of America. I get they're big. I get they're great. If you like them or not, those regional banks, we need them. So I will continue to stand on my preacher's box and preach at you to keep your money in there. We need them. We need to support them. We need them around. We need them for the small business and the local business and the startups and all the real estate deals and all that stuff they fund that you guys might not be aware of. They're a huge deal. So are banks going to tighten? Are they going to pull back? Sure. Why? Well, guys, they just went through hell in a handbasket, right? They just went through scrutiny. And of course, they got to take a couple steps back. They were already slowing down. Rates skyrocketed. They're not sure what's going on with property values. And you're hearing all these things and big commercial properties maybe having, value changes and people got into bad debt or bad situations. So yeah, we got to work through this situation and basically this next, whatever the time frame is, 8 months, 6 months, a year, 2 years, whatever it is. So banks are going to get more conservative. They are going to pull back. They might raise their rates. They've got to check their balance sheet. They got to make sure they're all in order. They're able to get through and survive the next 6, 8 months, year, 2 years, whatever it is. We need banks. So yeah, they have to be smart. They were already doing this, but now since they have a freaking microscope on them, they have to be a little bit more due diligence in what they're doing. What else I want to talk about is, the next trauma. The next thing that is going to be the biggest thing is what? The debt ceiling. Why am I talking about the debt ceiling right now? Well, some people are talking about it, but it's going to be on all your news, all your feed, all your media. Everybody's going to comment about it. It's going to be a shit show. Trust me. Why is it such a big deal? Because guys, we're going to enter the debt ceiling where Democrats let's just raise it. Republicans are going to say, no, we need to cut spending. And you're going to have this tug of war going on, right? And we might shut down the government for a day or weeks. We might not, but it's going to create volatility. It's going to create instability. It's going to create confusion. It's not bringing confidence to the market. It's just more drama that we don't need, but it's coming. And they're not going to deal with it now. They're going to wait to the very end and when it's a shit show, and that's when they're going to deal with it. Also, too, let's go back to the California Dream Program. So I was just shooting a video on this. I'm going to keep it brief. I gave some pros and cons. Let's just jump into them real quick. The pros is that there's no down payment. There's no mortgage insurance. You can qualify at the 80%. You can refi one time. It is a pro because some programs you can't. They'll subordinate that second. But with that, remember, Fannie and Freddie only go to an 97% combined loan to value. If you don't know what that means, I don't have time to explain. So if you're borrowing 100%, you need 3%. Then you have closing costs. So we think you're going to need 5 to 6% either equity gain, appreciation, or you got to come with the money. And the final, thing is you get better rates, better payment because this program is definitely benefiting people in that way. But the cons, let's talk about the cons. Number one, you got to pay for your closing costs. If not, you can use that 20% they'll give you and use it. But now you got mortgage insurance. So, it's this toss-up thing, and you got to just think, is it worth it or not? Second kind of thing is you got to pay your closing costs, right? You got to pay your own you got to pay your closing costs. You got to do the 5%, or you're going to get more insurance. That's the first thing. Sorry. Basically, you have to pay back 20%, and if you do a cash out refi or you sell, they get 20% of the upside. So you have a partner. So once you pay the partner back and you make $100,000 in your property, you pull out cash out or you sell it, you owe them money. Yes, they're a partner. They're in it. What I don't like is you can only refi one time. So that means if the rates drop in a year and you refi, you're like, yeah, I got a good rate. And let's say rates happen to drop again or better, you would have to pay them off to refi. So you're kind of trapped. You're stuck there. Number 4 is you're basically banking on equity. You're banking on your value to go up for certain things, whether you do a rate and term refi or a cash out refi, or you want to pay them off, you want to sell your house, because when you sell your house, you've got probably 5-6% or whatever it is of closing costs. So who's paying for that? Oh, you are. What if you have to sell your house and you're short on the equity? Well, you owe them money. How are you going to pay them back? I'm not sure how that works out. They have a workout program, but if somebody has to go move and they got to sell their house and they're 100% into it and it's worth maybe 10, 20 grand more, it's not going to cover your closing costs. You might have to come out of pocket with money. Keep that in mind. The last thing, what I really don't like, is that you kind of are stuck. I feel like you're trapped because, look, there are so many people that have a house. They're able to buy it, fix it up, use the cash out to buy another property, pay off debt, send your kid to college, fix up the house, start a business, all this stuff. And if basically that's not available, you can't do that. So the chances of you actually cash out, refi, and using that is probably dead in the future. Selling it, obviously you got to pay them back. And so the con is if you really want to move around, or you're not going to see yourself long-term in this house, or you like to refi and do things, this is probably not for you. But if you're like, hey, I want to buy a house and I'm the type of person I'll live there for 20, 30 years and I'll just refinance it once and I'm happy, that product is probably for you. So you should definitely look into it. Remember, limited on funds. It's only things going to help around 2,000-ish people. I don't know if they're going to come out with more money. We'll see. They were started at 500 million. They've already dropped the funding down into 300 millions. And so basically that's what you got. So besides that, guys, it's just day-to-day drama. It's the banking. It's the real estate market. It's, it's going to be the debt ceiling. But what's going on with the real estate market outside of residential, as you guys are hearing, it's starting to come out, is the commercial sector. So I don't know at all, but what's kind of coming out is you can see a lot of people bought these mega deals, development deals, ground up construction deals, bought office buildings, all this, and they got good debt. The tenants left. So you're going to have a lot on these massive, massive deals, and small, but a lot of the big deals where people syndicate or bought deals or office or all this stuff, apartment buildings. Maybe they got bad debt. Maybe they got floating debt where it's like SOFR plus this and they can't even afford the payment. Maybe they bought an office building. It's been great. Now it's 50% vacant. Nobody wants to live there, like in San Francisco. There's going to be a lot of people buying these big buildings at a discount, banks having to do some maneuvering when the refis come up and the building's vacant. So commercial is definitely going to feel some pain. Look, you put trillions of dollars into the system. You basically refinance trillions and trillions of dollars. You basically gave people trillions of dollars, businesses, people. What do you think is going to happen? We're not just going to walk out of this scot-free. We saw interest rates jack up. You're seeing confidence. You're seeing things kind of, confidence in the market and this like this. This banking debacle scares people. So we got to step back. We got to see what in the world's going on. We got to use our brain. We also got to make sure we're paying attention and watching the right things. Be careful of who you're watching, who you're learning from, where your data is coming from. Speaking of data, before I go, that's my kind of consensus is the market is, guys, there's a lot of fear, a lot of things. Make sure you're getting your facts from somewhere. But speaking of data, reminder, April 5th, mark your calendars, 10 a.m., Data Over Drama, my webinar. Talking about it everywhere. I'm telling you, please listen. If you're in real estate, care about real estate, sell it, finance it, buy it, invest it, flip it, wholesale, whatever it is, you got to see this. I'm telling you, I've showed this to a few people. They're like, Kenny, I've never seen charts like this. I've never seen this information. I didn't know they existed. Wow. This has completely changed my mind. Wow. I learned so much. It's not about the guys. I'm telling you, when you understand the data and what's going on, when you hear a bullshit story, your uncle or your cousin or some client or something tells you something and you're worried about it because you don't know what's going on, when you have the data, you have the facts, it makes you so much better as an investor, anything. So I will go through the stuff that I thought was important for you to know. Couple things. What's going on with rates? What's going on with inflation? But why do we have such low inventory? What happened from 08 to the difference from today? Like getting into the details. I'm going to show you the difference. We're going to go through some of the important things. I don't want to give it away. So April 5th, 10 a.m. It's all over my social that. I'm going to send an email out. Make sure you guys subscribe, listen. Obviously, there'll be recordings later, but I'd love to see you on there live. But otherwise, in closing, guys, we got to stay focused. We got to keep our eye on the prize here. And yes, we're going to continue to get data. I'm just giving you guys a heads up. The next drama that's going to shoot a drop will be the debt ceiling. It's slowly starting to come out. But as we get closer and closer to June, we get through April, May, it's going to start becoming overpower everything. And if they just keep letting it go, it will be a shit show. So you could see stocks drop. You could see rates drop. So we'll see some volatility. We'll see what happens. But ultimately, we need the government to work together, figure this out. But, we can't keep the spending up. We got to cut at some point. That's what the argument here. Until next week, we will continue watching rates, inflation, inventory. Where is our inventory? We don't have it. Until next week, appreciate you guys watching. Please share this. Want me to talk about anything, let me know. Otherwise, have a great week. Thanks for stopping.